Okay, so you're wanting to know the difference between mutual funds and exchange-traded funds. Let's go ahead and talk about what everyone has a love-hate relationship with: potluck dinners. Okay, so you're getting ready to have a potluck dinner as a host, and you are wanting to create a meal along with everyone else creating a meal, and your meal is specifically going to be for everyone. So you want something that everyone's going to hopefully like and appeal to all of them. So what do? You go down to the local farmer's market, and you go ahead and choose a little bit of everything: the fresh fruits, the vegetables. There's a farmer there that has his meat and his dairy, from his local farm. So you choose a little bit of everything and you make a meal for everyone. That is what we're going to call an exchange traded fund. So you have a little bit of everything. So the farmer's market is the stock market, and you're choosing a little bit of everything. Now imagine, as the host, that a couple of the people coming have gluten allergies and have dairy intolerances. So instead, now you're going to the farmer's market, which is that stock market, and you're picking and choosing different items to make sure that you're appealing to what the different people have. So you're making some type of dish that's actually catered to them. That's going to be more like the mutual fund, where you as the host are going to be the mutual fund manager who's actually going to be picking and choosing the individual stocks and bonds that are going to be a part of it. So let's go ahead and real quick go over the differences. I'm going to pop over to my whiteboard and we can go ahead and talk through this. Okay, so let's go ahead and get away from the idea of potlucks, because we know that we all get stressed out trying to get our house clean and trying to make sure that we have the perfect meal. Let's just talk real quick about what ETF and mutual funds are and the key differences. So I broke this down into 6 real simple categories for us. The first one's going to be trading. So mutual funds actually only trade once a day. Now the price does fluctuate throughout the day, but once per day is when you're going to be able to trade that. ETFs work more like stocks, where they are trading throughout the day, so you can buy or sell them at any point in time that the market is actually open. So we're going to put market time. So anytime that you want to, you can go ahead and purchase into an exchange traded fund. Now the pricing, because the mutual fund only sells and trades once a day, that's at 4 p.m., the pricing is going to be one price. So you're going to either buy or sell at whatever the price is at 4 p.m. when the stock market is actually closing. Versus with the exchange traded fund, that's going to be fluctuating. So I'm just going to draw a little graph here, because it's going to be fluctuating depending on the day and the time that you're actually looking at buying or selling into that exchange traded fund. Then we have management. Because, think about that host again, you have an actual fund manager with mutual funds, someone who's picking and choosing, do I want Coke or do I want Pepsi? So you have a mutual fund manager who's actually trying to possibly beat the market, possibly actually have extra returns to make sure that their fund is the best one out there. Versus exchange traded funds are more passive investments. Now, there are some exchange-traded funds that do have fund managers, but majority of them are going to be more passive, where they're just trying to follow a stock index. Think about the Russell 1000 or the S&P 500. They're really just trying to follow it. Because they're trying to follow it, the cost is going to be very minimal with ETFs. There's always what's called an operating expense ratio, which is that internal cost. The exchange-traded funds are going to have a much lower cost, where mutual funds a lot of times are going to average between 0.75 to 1% per mutual fund. Now, there are mutual funds that are higher and mutual funds that are going to be lower, but a lot of times you have a higher added cost specifically because of that. Where with exchange-traded funds, you might be in the 0.2 to 0.4% range. That's a pretty substantial cost savings for you. Then you have tax. Because someone is actually trying to trade those mutual funds throughout the day, and they're trying to pick and choose the different stocks, a lot of times we're just gonna put a little kind of sad face there, because a lot of times you might pay more taxes because they're turning over those investments more often. So you might have more capital gains, you might have different types of taxes that are actually there. Where with exchange traded funds, they're going to be more tax efficient because they're holding those investments over the long time. They're not picking and choosing them and trading them often. So it's going to help minimize some of the taxes that you're paying. To us here at Paramount, really the most, we focus a lot on that behavioral side. And a lot of times mutual funds, and Dave Ramsey talks a lot about this because he doesn't want you thinking that you can time the market. There's this saying, time in the market versus timing the market. Trying to get in and out and trying to make sure that you have the best investments, kind of more like gambling, versus holding it in the long time and just staying in the market. We use ETFs primarily here at Paramount Financial, although there are times where mutual funds might be appropriate. We tend to stick towards the ETF route because we want to help lower those costs. When we lower those costs, it puts more in your pocket. And we are able to take away the behavioral side because we're here as that behavioral coach for you. So hopefully you guys learned something today, understand a little bit more about it. If you want to talk about it, feel free to come in and talk. Let's find out what we can do together.